Investing for beginners. Top ways to invest your money. Welcome back to the channel. Today, we're diving into one of the most important topics for your financial future: investing. You hear it everywhere you turn, but it can seem really complicated and confusing when you're first starting out. Whether you're a beginner or looking to diversify your portfolio, this video will cover the top ways to invest your money. We'll break down each strategy in detail, discuss the pros and cons, and help you figure out which investments might be right for you. So, let's start with the basics: stocks. When you buy a stock, you're essentially buying a small ownership stake in a publicly traded company. Think of it like becoming a tiny shareholder. You're hoping that the company will grow and become more profitable over time, which should, in theory, increase the value of your shares. Now, there are a few key things to remember about investing in stocks. First, it's crucial to diversify. Don't put all your eggs in one basket, or in this case, all your money into one stock. Instead, spread your investments across different companies, industries, and even countries. This helps to reduce your overall risk. Second, understand that investing in stocks comes with inherent volatility. The stock market, as they say, can be a wild ride. Prices can go up and down in the short term, and it's important not to panic sell if your portfolio takes a dip. Remember, you're investing for the long haul. Speaking of the long haul, historically, the stock market has delivered an average return of around 10% per year. While past performance is not indicative of future results, it does illustrate the potential growth that can be realized by staying invested over the long term. It's also crucial to remember that this is just an average. Individual stock performance can and will vary. Now, how do you actually buy and sell stocks? Well, you can either use a traditional brokerage account or a robo-advisor. Brokerage accounts give you more control over your investments, but they also typically come with higher fees. Robo-advisors, on the other hand, use algorithms to manage your portfolio for a lower cost. But no matter which option you choose, remember to do your research. Look into the companies you're considering investing in, understand their financials, and consider their long-term prospects. Knowledge is power, especially when it comes to successful investing. Now, let's move on to bonds. Bonds are a bit different from stocks. When you buy a bond, you're essentially loaning money to a government or a company. They agree to pay you back the principal amount at a later date, called the maturity date, along with periodic interest payments. Bonds are generally considered less risky than stocks, as they offer a fixed rate of return. This predictable income stream makes them a popular choice for investors seeking stability and income, especially those nearing retirement. However, the trade-off for this lower risk is typically lower potential returns compared to stocks. You won't see the same explosive growth potential you might find in the stock market. There are many different types of bonds available, ranging from government bonds, considered very safe, to corporate bonds, which carry slightly more risk but offer higher potential returns. Just like with any investment, it's essential to diversify your bond holdings as well. Consider investing in bonds with varying maturity dates and credit ratings to create a well-rounded portfolio. Bonds can be purchased through the same brokerage accounts you'd use for stocks, making them easily accessible to investors of all levels. Remember, while bonds may offer a lower potential for growth compared to stocks, they play a vital role in a diversified investment portfolio, providing stability and a steady stream of income. Chapter 3. Investing in real estate. Building wealth through property. Now let's talk about real estate. Real estate investing can be a fantastic way to build long-term wealth, but it's also important to understand the nuances. One of the significant advantages of real estate is its potential for appreciation. Over time, property values tend to increase, especially in desirable locations. This can lead to substantial profits if you decide to sell down the line. Another perk of real estate investing is the potential for rental income. By purchasing a property and renting it out, you can generate a steady stream of passive income, helping to cover your mortgage payments and potentially generate positive cash flow. However, it's crucial to remember that real estate is not a completely passive investment. Being a landlord comes with responsibilities, from finding and managing tenants to handling repairs and maintenance. There are also various ways to invest in real estate, each with its own set of risks and rewards. You can purchase rental properties directly, invest in REITs, real estate investment trusts, or explore crowdfunding platforms that allow you to invest in larger commercial properties. Remember, location is key in real estate. Thoroughly research neighborhoods, consider factors like job markets, school districts, and future development plans before making any investment decisions. Real estate can be a fantastic way to diversify your portfolio and build wealth, but always remember to do your due diligence and invest wisely. Chapter 4. Mutual funds. Investing with professional management. Let's dive into the world of mutual funds. Mutual funds are an excellent option for investors who prefer a hands-off approach and want professional management of their investments. In simple terms, a mutual fund pools money from multiple investors, like yourself, and then invests that money in a diversified portfolio of assets, such as stocks, bonds, or a combination of both. The beauty of mutual funds lies in their simplicity and diversification. By investing in a single mutual fund, you gain instant exposure to a basket of assets, reducing your overall risk. Another advantage is that mutual funds are managed by professional fund managers, whose job it is to make investment decisions on your behalf. This can be particularly beneficial for investors who lack the time or expertise to actively manage their portfolios. However, it's important to note that mutual funds typically come with fees, known as expense ratios. These fees are a percentage of your investment and are charged annually to cover the costs of managing the fund. When choosing a mutual fund, it's crucial to consider its investment objective, historical performance, fees, and the fund manager's track record. Mutual funds offer a convenient and diversified way to invest in the market, especially for those seeking professional management and a simplified investment approach. Chapter 5. ETFs. The flexible alternative to mutual funds. Now, let's talk about ETFs, exchange-traded funds, which have gained immense popularity in recent years. ETFs share similarities with mutual funds in that they offer diversification by investing in a basket of assets. The key difference is that ETFs are traded on stock exchanges, just like individual stocks. This means you can buy and sell ETFs throughout the trading day, providing more flexibility compared to mutual funds, which are typically priced only once a day. ETFs also tend to have lower expense ratios compared to mutual funds, making them an attractive option for cost-conscious investors. Just like mutual funds, ETFs can track a wide range of asset classes, from broad market indexes like the S&P 500 to specific sectors like technology or healthcare. This allows you to tailor your investments to your specific interests and risk tolerance. When choosing an ETF, consider factors like its expense ratio, trading volume — higher volume generally means lower trading costs — and the underlying index or assets it tracks. ETFs offer a flexible and cost-effective way to invest in a diversified portfolio, making them an increasingly popular choice for both beginner and experienced investors. Thanks for watching. If you found this video helpful, make sure to hit the like button and subscribe for more financial tips and investment strategies. Investing is a journey, and it's never too early or too late to start building your financial future. Remember to consult with a financial advisor if you need personalized guidance. Leave a comment below with your favorite investment strategy or any questions you have. See you in the next video.